Have you ever wondered why businesses keep track of their assets over time? The answer is depreciation, which is the gradual decline in an asset's value due to wear and tear, age, or obsolescence. Understanding depreciation is crucial for businesses to reflect the true value of their assets accurately. Depreciation isn't just a dry accounting term. It influences financial statements, taxes, and investment choices. By monitoring depreciation, companies can give investors and stakeholders a realistic view of asset values. There are various methods to calculate depreciation, with the straight-line method being the most common. In this method, the cost of an asset is evenly spread over its useful life. For example, a 10,000 machine lasting 10 years would depreciate 1,000 each year. Then there's the declining balance method, which accelerates depreciation in the early years. Using the same $10,000 machine at a 20% declining balance means it would lose $2,000 in value in the first year. Finally, the units of production method ties depreciation to actual usage of the asset. If a machine produces 100,000 units over its life, each unit has a depreciation cost. So, producing 10,000 units in a year would mean a $1,000 expense. Depreciation impacts financial statements too. On the income statement, it's an expense that lowers taxable income. On the balance sheet, accumulated depreciation reduces the net book value of assets, giving a clearer picture of financial health. And let's not forget the tax implications. Many systems allow businesses to deduct depreciation from taxable income. This can significantly reduce tax liabilities and free up cash for investment, especially for capital-intensive industries. But there are myths to debunk. Not all assets depreciate at a constant rate. Factors like usage, technology, and market conditions all play a role in an asset's value. Accurately estimating useful life and adjusting methods is key to avoiding misleading financial reports. Real-world examples show how businesses apply depreciation differently. A manufacturing company might prefer straight line for predictability, while a tech startup may opt for accelerated depreciation for tax benefits. Retailers might segment asset components for more precise accounting, each approach shaping their financial strategy. The future of depreciation is changing with digital assets and AI-driven analysis. Companies can now adopt more flexible methods for accurate financial reporting and better decision-making. Understanding depreciation is vital for managing assets, taxes, and business growth. For more insights on depreciation and financial management, visit HUMANITYUAPD.com.